In this video, let's learn the basics of bond analytics. Interest rates are the price of money. They play a crucial role in the fixed income market by influencing pricing, investment decisions, risk management, performance analysis, and overall market dynamics. In this video, we will learn about the basic interest rate concepts governing the decisions by the participants in the fixed income market. The guiding financial principle behind any investment decision is to boost the money in hand. The concept of time value of money underlies most investment choices in the fixed income market. In simple words, it states that money has a time value as a rupee in hand today is more valuable and useful than a rupee received at any future point of time. The worth of money can change over time as money in hand has the potential to earn interest or grow in value if invested. Investors require compensation in the form of interest for foregoing their current consumption. Thus, while making a financial decision, one needs to consider not only the amount of money involved, but also the time when one will receive or spend that money. There are two main reasons for this. Delay in making investments gives rise to the opportunity cost of missing out on potential returns, and rising prices of goods and services or inflation mean that a rupee will buy less in the future than it will today. Investors have to choose between the alternative avenues based on their financial needs, goals, and risk-taking ability. With application of time value of money concepts, investors can select the best investment option in terms of returns. Time value of money is based on the concept of interest or income on savings. Reinvesting interest income gives rise to further interest income. That is, interest on interest. Hence, when interest is accrued for more than one period, it becomes necessary to distinguish between simple interest and compound interest. Simple interest is the interest rate without any reinvestment. In other words, simple interest is like getting paid a flat rate for lending your money. On the other hand, compound interest is interest earned on both the original investment amount and the interest that has already accrued. Compound interest is often considered a powerful tool for growing wealth. This example illustrates the difference between simple interest and compound interest income earned by an investor over a period. The cash flow difference starts widening the longer the period of investment. This difference is on account of the interest earned on the interest income under the compound interest method. Some common examples of simple interest income are the interest received on savings accounts of banks, and of compound interest income are the interest received on fixed deposits. Thus, the longer one has access to money, the more opportunities one has to invest and earn a return. In other words, money has different value at different points in time. This brings us to the key concepts of present value and future value. Present value, or simply PV, is the current worth of an investment that will pay a certain amount of money in the future. Simply put, PV is today's value of an amount of money that will be received in the future. Discounting is the process of determining the present value of a future sum of money. Future value, or FV, on the other hand, is the current worth of an investment that will pay a certain amount of money in the future. Compounding is process of growth in the value of the investment on account of the reinvestment of the accumulated interest. Present value and future value are closely related. The present value formula is the core formula for the time value of money. As present value is the amount of money that must be invested today at an interest rate of R per period for T periods to produce a specific future value. Future value can be calculated using this formula. Similarly, the present value can be calculated using this formula. Thus, future value and present value are inversely related. This is because the longer one invests money, the more money they will earn from interest, resulting in a higher future value. Conversely, the shorter one invests money, the less money they will earn from interest, resulting in a lower future value. Let us understand these concepts with an example. What will be the value after 3 years if 1000 rupees is invested amount today at an interest rate of 6% compounded annually? Here PV is 1000 rupees, which is compounded annually for 3 years. Using the future value formula, we get a maturity value of 1191 rupees. Conversely, the present value can be calculated from the known future value by using the PV formula. Thus, we find that the present value of 1191 rupees received after 3 years is 1000 rupees today. Generally, the longer the time period and the higher the interest rate, the greater the impact of compounding and discounting. Understanding the concepts of future value and present value is crucial for making informed financial decisions and achieving long-term financial goals, including saving for a specific goal such as for retirement, comparing the potential returns of different investment options, determining the cost of borrowing money over time, and setting the terms of a loan, such as the interest rate and repayment schedule.